everybody wants to find the perfect analog for the current bear market, because if you can find that, then that sort of gives you a playbook. If I can say, well, this specific bear market in the past looks just like the current one, well, then I know what I need to do, because I know what happened during that bear market and I know what happened after that bear market. And so there's a tendency for all of us to try to look back and find the bear market that perfectly matches what's going on, especially bear markets we've actually been through, because all of us tend to, put more importance on bear markets that we've actually seen versus, something that happened in 1920 that we never went through. So the point of the article was to say, although that can maybe be a helpful exercise, every bear market is different, and there haven't been that many bear markets. And so the odds of of the current bear market looking exactly like any of the past bear markets are actually very low.
Okay, so let's start with the bear market that we went through as professional investors, which was basically 2007 to 2009. So that's considered the great financial crisis. I think it was the second worst bear market, peak to trough in history, after the Great Depression. And I think when you go through a market like that, as investors that experienced it, one of the ideas is that the next bear market, in your mind, you may anchor to that as an investor. You may say, okay, we had, a 50% plus decline. So this decline that we're going through, many people might think it's going to be equally as bad. This is obviously a result of a completely different type of thing, but the point is that, you're probably, at least initially, most likely to anchor to the bear market that you've personally experienced, like you just said. And the last real bear market was the second worst in history. And one of the things that you and I have sort of talked about as well is, the next bear market may not be anywhere near that in terms of the types of decline. Obviously, what caused the bear market was different than what we're in today. But, investors have a tendency to think that the thing is going to repeat itself. And that's not always what happens with these bear markets.
Yeah, you make a good point, because, if you look at our career, we went through 2008, and we were just starting our career when 2000 happened, and 2008 is the second worst bear market ever, and 2000 was either the third or fourth, I think.
Right.
So, you might look at that, if that's all you've been through, and say, all these bear markets are horrible. They're all 40, 50% declines. And that's not the way they play out. Most bear markets are actually closer to the 20 to 30% range than they are the 40 to 50% range. But also the details behind it are very different. So 2008 was a financial crisis. We had people owning homes, or owning multiple homes that shouldn't have been owning them. We had the financialization of all that, which led to a huge issues within the banking system. Coming into this one, the banking system's actually, as of right now at least, is in pretty good shape. So it was a totally different type of crisis. What we're dealing with right now is something we've never seen before. We've never just shut down the economy for an extended period of time. And as of now, we don't even know how long that's going to be. So that in and of itself makes this completely unique relative to all other bear markets, but also relative to 2008.